Wow, Tesla stock today fell 2.84% to close the trading day. It was down almost 5% at one point today. What's crazy about this is the stock was actually doing very well in the beginning of trading, up about 3%. We have some massive breaking news to share with you in regards to tariffs. Tariffs are going into effect tonight. 25% on Canada, 25% on Mexico, and a surprise 10% additional tariff on China. And I think that's the part the markets really don't like today. Now, obviously, the markets do not like the Canada-Mexico tariffs either. There was some hopes that after threatening 25% tariffs, and some of the comments we heard from the Commerce Secretary today, Lutnick, he said that Canada and Mexico have done very well on the border. Apparently, it's not enough. So a lot of people were hoping we get 10 or 15%, and that would be seen as positive for markets. Does not look to be the case. So I will share with you the latest details that we have on this developing situation, how this can impact the markets, a really negative technical setup that we now have on the SPY. This is a bearish engulfing candle, and what tends to proceed after these doesn't tend to be very good. We have some data coming out tomorrow morning that I think the markets are going to pay attention to, but it's really going to be about retaliation to the tariffs. Does Mexico retaliate? Does Canada retaliate? Does China retaliate? And really, the big one is China. Now, I will tell you, we do have a historical precedence of this. This is not the first time this has happened. Okay, 2018, I know a lot of you guys were probably not invested in the markets during this time, but during 2018, it's kind of like what we're seeing now. It was a very volatile situation, and it was the trade war 1.0. Now, this time feels a lot more aggressive, okay, than 2018. You just kind of wake up to Trump making a tweet, markets would sell off, we put tariffs on China, China put tariffs on the US, and then we all kind of relaxed when the SPY was down 20%. Okay, so we fell 20% during the last trade war. What's interesting about 2018, again, if you were invested in markets during that time, we also had growth concerns. Okay, we had a bit of a growth scare. You had a little one in 2018 in the beginning as well, and then a larger growth scare really on the back of this trade war 1.0, we'll call it, towards the end of December. And markets actually bottomed on Christmas Eve and then started to recover from there. So yeah, we're in a very tricky situation now for markets. What's actually very fascinating as well is TLT today went up around 0.5%. Now, partially this is due to bad ISM manufacturing data that we had this morning, but the other part of it is as the market started to sell off today, TLT started to rally. And it was really rallying all day, but you can see really here as markets started to sell off, TLT started to rise. So TLT is seen as now this hedge for investors. And even as Mike Santoli said on CNBC today, these tariffs, the bond market's really not seeing it as super inflationary. They're seeing it as an issue for economic growth. And I think that is ultimately the direction that we're headed in. You can see here, the Atlanta Fed GDP Now tracker is tracking negative 2.8% Q1 GDP. Now, I know what a lot of people are going to say. They're going to say this is, the typical argument that it takes the last data report, like manufacturing data we got out today, and the data that we got out yesterday with personal spending, and the big miss on the goods trades balance. And it basically plugs in those numbers on a continuum basis for all of Q1. Like if we get this same level of bad data throughout the rest of this quarter, you're going to be at negative 2.8% GDP. So odds are this is going to come up a bit, but you're now in deep negative territory. You could start to get a lot more of those growth concerns, recession concerns. Now, what we're experiencing right now is a growth scare. What you could start to see and start to hear is a recession scare. And a recession scare could send markets down a lot more than the 5% that we are currently down from all-time highs right now. And again, the markets are up a lot over the past couple of years. We've had really good back-to-back years. How does that play into it? I don't know. The dips that we have had, the correction events that we have been short-term, okay, over the past couple of years. Do investors go out and buy that? I think it really depends on, again, retaliation and how the data comes out this week. The data that we're going to get this week is going to be critically important for markets. And you can see here, it says the White House, from the White House, that Trump has signed an action to tariff China at 20%. The White House cites China's inaction on fentanyl for tariffs. Trump said today that there is no room left for a deal on tariffs on Mexico and Canada. And here you can see Trump confirms 25% tariffs will start on Canada and Mexico Tuesday. That is technically tonight at midnight. So it doesn't look like there's anything Mexico or Canada can do to avoid these tariffs. Now, Trump says he does not think that China will retaliate too much. If they don't retaliate too much, then that is going to be, more positive than not, okay? But if China wants to retaliate and do a similar style tariff, markets are not going to like that, because that could mean, an escalation of the trade war. That could mean a new tariff being put on China, and then China putting a new tariff on the US. That's kind of how it was in 2018. Also says that he will penalize countries weakening currencies with tariffs. And this was kind of a jab to Japan and the Japanese yen, where Trump actually said the yen during the press conference today. So I don't know what that exactly means, implications for Japan. We'll have to see. And Canada was watching this press conference like a hawk, because right after Trump said this, within minutes, Canada's foreign minister says, quote, "If Trump imposes tariffs, we're ready," saying that Canada is ready to put tariffs on $155 billion of U.S. goods, with $30 billion starting in the first tranche. Now, again, the data that we got this morning with ISM manufacturing PMIs, in case you missed it, was bad across the board. The headline number didn't come in too bad, but that was really because prices paid came in so high. So when you factor out prices paid, you actually see an ISM manufacturing really, really bad. So the inflationary component of the manufacturing PMIs today really caused the headline number to not look as bad. Manufacturing employment came in at 47.6 versus estimates of 50.6, so that's really bad. Construction spending month over month came in negative 0.2% versus estimates of positive 0.3%. Really bad. Manufacturing new orders came in at 48.6 versus estimates of 55.4. Really, really bad. And then again, ISM manufacturing prices came in at 62.4 versus estimates of 55. So that's where you got some of the headline, what looks like strength in the manufacturing PMIs, but it's not. Now, tomorrow is actually the slowest day of economic data, but a couple things that will be important here. Number one, RCM TIPP Economic Optimism Index. Okay, you want to see this come in good, right? Especially right now when a lot of people on Wall Street say there is this growing confidence issue with consumers out there, okay? And you have recently seen this thing recover from some of the lows that you hit October of 2023 and June of 2024. It started to recover alongside really the election. After the election, this thing really skyrocketed. If it comes down, Wall Street's not going to like that. Now, considering the recent data that we have gotten, you will get a speech from Fed Williams tomorrow. Now, Fed Williams will speak at 2:20 p.m. He is seen as the guy that might be the runner-up after Jerome Powell steps down as chairman in 2026. Okay, so he has been more bullish, more leaning towards Trump's policies, and could overall be a positive for markets tomorrow. We'll really have to wait and see. Wednesday, you have the ADP employment change, ISM services, PMIs, and other smaller data sets, including I believe initial jobless claims is Thursday. Balance of trade, exports, imports, wholesale inventories. This will go into another Atlanta Fed GDP Now update. We'll get the next one Thursday, March 6th. So if that data comes in bad as well, you could just see this thing fall even more, which at some point people are going to say, oh man, we're negative almost 3% on Atlanta Fed GDP. What are the odds that Q1 GDP comes in negative? And then when you factor in tariffs are paid by the importing company, right? Or country. So Nike, for an example, is going to have to pay tariffs on the goods that they are importing from China. Nike's a US-based company. That's going to hurt Nike, right? So again, bond market is reacting like this is something that's not really inflationary, but is actually going to be bad for the economy, which I think is pretty accurate. Mix this with some of the government spending, spigot being cut off and Doge layoffs and overall government layoffs, and you could be up shit's creek pretty fast here. Okay, now non-farm payrolls are expected 153,000 on Friday. I think that's way too high. I think that number could come in substantially lower, like 100,000 lower. And when I also think about it, there's a lack of respondents in this non-farm payrolls survey these days. The government's going to, actually respond to how many people they laid off. So we're expecting negative 20,000 government layoffs. That number could be higher, right? And if it's offset by not as many other businesses reporting good things, that's where you're going to get a miss to the non-farm payrolls. The unemployment rate is expected to stay the same. You also get a speech from Fed Jerome Powell on Friday at 12:30, so around lunchtime. Fed Kugler, Fed Williams, and Fed Bowman will also be speaking Friday morning. Now, you can see today, again, as I've explained, bond yields fell about 6.5 basis points today to 4.163%. This is exactly what the Trump administration wants. Now, again, think about the 60-40 portfolio. 60% stocks, 40% bonds. They are supposed to inverse each other. So bonds are going up right now, stocks are falling. By definition, if the administration wants to lower 10-year treasury yields, they want stocks to go lower. Now, how low are they willing to tolerate? What's their ultimate goal and destination? I don't think they want a bear market or necessarily a recession. Some people have suggested Trump would be willing to forego a shallow recession to really reset 10-year treasury yields, get mortgage rates affordable again, auto, loan rates more affordable. That's still a question, but it is growing more obvious to me that Trump really doesn't care about the stock market this time around. Now, the Dow sank 650 points today, down about 1.5%. S&P fell 1.76%. NASDAQ down 2.64%. Russell 2000 down almost 3%. The VIX was up 16% today, now hitting 23. So what's wild here is we really haven't had the big volatility spike, right? We really haven't had the oh my gosh, let's panic moment. The VIX has been going up like 10-15% on these really bad days. When the VIX is up like 100% in a day, that's when you're like, okay, this is probably overblown. But we haven't seen that yet. I don't know when we'll see that. I don't know if we'll see that. But to me, it doesn't seem like the VIX is screaming this is over yet. It just seems like more people are starting to pile into hedging positions. Now, CNN Fear and Greed Index is back into extreme fear territory at 24 today. Yesterday, you were at 19, or Friday, you were at 19. So potentially still could go into more fear here, but you are pretty fearful. And again, overall, I think we could bounce here, right? If the bad news flow does stop, you could be in for a bounce. Where I want to caution you is investors are going to sell the rip, sell a bounce, until we get more clarity on the economy. With the economy looking like it's starting to fall out of bed, tariffs are one part, economy is the other. Even if the tariff concerns die down, I don't think you're going to be ripping to all-time highs until until it looks like the economy is stabilizing, or until we get a better understanding of the economy, and or the Fed can be accommodative. Because half the battle right now is really that the economy is weakening, and there's this tariff threat that sounds like it should be inflationary, but will actually be deflationary. The bond market is telling you that they are more worried about economic activity. The Fed is more worried about inflation when it comes to tariffs. And right now, the economy is weakening. So it's just a really bad situation for the markets, but ultimately for the economy. Because any other time in the past, 12 months or so, when the economy starts to weaken, the Fed gets more bullish. The Fed put really comes into play, but now it's just not here because of that tariff threat. And unfortunately, it's like, who's going to break first? Okay, we got the announcement that tariffs are going to be implemented tonight, 25% on Mexico and Canada, another 10% on China tonight. Okay, now that that's being implemented, like, it doesn't all of a sudden mean the Fed can just be bullish again or be dovish again. Now the Fed wants to wait and see probably a couple of months how the tariffs could affect the inflation situation. By then, you could be up shit's creek in the economy. And I think that's where the problem is, that I'm hesitant to be more bullish on markets. Now, maybe the Fed sees the light at the end of the tunnel after all. Maybe they realize what I'm saying here. But as of now, they have not. And that's why I think Fed speakers throughout the rest of this week, specifically Fed Jerome Powell on Friday, couple that with the ISM data, ADP jobs report, a new initial jobless claims, again, the unemployment rate, all of that will kind of push maybe the Fed to be a little bit more dovish, but they're not going to rush to be cutting rates after tariffs get enacted. It's hard to be bullish in that situation. Again, I'm bullish on stocks like Tesla. A quality name like Tesla down 42% from all-time highs, down another 0.5% in after hours right now. Like, you want to buy that, okay, in my opinion. But the S&P, Apple, other names that are near all-time highs do not look attractive at all. You really got to start asking yourself, what if I'm wrong, right? That's what I'm saying to myself. What if I'm wrong and things recover? We don't have a recession, in which I'm not necessarily forecasting a recession, but I think it's going to get doom and gloomy here in the next couple of months. I think Wall Street might start to throw around that recession word a lot more. In that scenario, that puts pressure on stocks. But what about the scenario in which I am wrong and things are just fine out there? Like Doge has no impact. Government layoffs are offset by private sector jobs. There's a way for companies to mitigate the tariff impacts, and that does not hurt the labor market or overall GDP. In that scenario, Tesla's going to go up a lot. In the adverse scenario, if I'm correct and the labor market weakens, the economy continues to weaken, the Fed is just a little bit too late to recognize this, and markets fall another 10% from here, let's say, how much downside is left in Tesla? I don't think that much. Could you get down to 200? Sure. I mean, that's theoretical downside from here of about 29%. But the upside, if I am wrong, could be hundreds of percents, okay, by the end of this year. And that's why I like Tesla, buying it down 40% right now, but not other areas. So you really got to be stock by stock, very specific on this. Look at Apple right now. And I know I'm picking on Apple, but I mean, they're sitting near all-time highs, going to be under immense pressure as the consumer weakens. What's the upside for Apple this year? Even if things are great, I mean, from current levels, 15% upside would put you at 274. Your all-time high was 259. Okay, so substantially above your all-time high. That's 15% upside from here. The downside from here, to get back to where you were in April of 2024, is downside of 31%. I mean, you're looking at a magnitudes worse risk-reward profile than even something like a Tesla. So that's why you want to be specific. Now, you can also see here on the SPY, you have a bearish engulfing candle where a big red candle. You opened up. Buyers were in control. We've seen markets did pretty well in the beginning of trading. You come down and you close lower than the opening price of the previous day. So this is bearish. And if you want to just look at what this kind of looks like in, picture form here, that's what it is. Right? You opened here the previous day, which was in this case Friday. You ran up to the highs to start the trading day and then closed lower than the previous day. That is typically not a good pattern for stocks, and it does tend to precede lower levels in markets. Now, I don't want to scare anyone here because obviously nothing is guaranteed, and one headline can make the difference between a larger crash or a full-blown recovery. But we do have a playbook for this back in 2018. And, again, it just sounds more aggressive this time around, but you never know. So I think you really want to be in a situation to obviously take advantage of however this plays out. Do I think you should be selling everything right now? No, right? I would never say that's a good idea. Do you want to raise cash as much as possible? Yes. And people have asked, what do you mean? I mean, get a second job, mow lawns, take back, it sounds stupid, but if you have a lot of change, take back your change. Do whatever you can to get a couple $100 extra, because if shit does hit the fan, that could make you thousands if you're able to buy at the most opportune moments. Okay. If even Warren Buffett picks up 10 cents on the ground, don't kid yourself. You're not superior to Warren Buffett in that sense. Do whatever you have to do to get some extra money right now. But you also want to be taking advantage, in my personal opinion, of the specialized deals out there, like Tesla, for instance. It's down 40+% from all-time highs. It's priced in a lot of bad news. Now, if the markets do continue to fall, Tesla's going to fall as well. Okay, bottom line. But if markets recover, Tesla's obviously going to recover a lot more. And if things do not continue to get worse, then Tesla could recover. Like even what you've seen today. Nvidia was down a lot. Tesla was up a lot. So as long as you don't have a full-blown crash or there's not too much fear out there, if fear subsides, you could even see the markets trend lower and Tesla could trend higher. Okay, so I think, again, Tesla's a buy here, hands down. The SPY? No. It's just way too close to all-time highs to be an attractive buy. I also want to point you to the SMH ETF. This is the semiconductor ETF, and this thing looks bad. Okay, last time it broke below its 200-day moving average and consistently closed below it was back in 2022, and this ETF fell 37%. From your 200-day moving average till now, you're only down 9%. Semiconductors tend to be cyclical. They tend to lead bear markets or lead stock market crashes. They tend to sell off first and recover first, and you are definitely selling off. I mean, you have been selling off even before the markets were really drawing down. You're still yet to hit your previous all-time high in July of 2024. You never even hit a new all-time high. Even though Nvidia was at an all-time high, other semis were not. So I do think this is kind of a red flag for the broader markets still. Now, we actually had some really good news for Tesla today. It looks like FSD is going to launch in the Australian market soon. The Model Y has officially started deliveries in the US. Among other great news we talked about in the previous video, there was a reason why Tesla was up today. Yeah. Morgan Stanley's Adam Jonas reiterating his bull case for the next 12 months for Tesla is $800 per share. Does Wall Street give a rat's ass about that right now? No. It is sell first, ask questions later. That's the kind of market that we're in right now. But you don't want to ignore the good news, because inevitably good news is good news, and positive company fundamentals will reflect in due time, but not during stock market crashes or corrections. Right? That's why you get deals and discounts, because emotions run wild. And if you like what you're seeing out of Tesla recently, which I don't know how you couldn't. I mean, FSD launched in China and in Mexico. The new Model Y is sold out in some markets with 3-month wait times in China. Like, all of that is great news. And the emotions right now running so high with the fear out there that there is just giving you an opportunity in Tesla. Again, it could fall further, but I do expect that we will see a bounce, right? I think it's going to be very choppy. This market's going to kind of be like 2022 to a certain extent. Maybe you're not going to fall 27%, but you're going to fall, you're going to bounce. You're going to fall, you're going to bounce. You're going to fall, you're going to bounce. You're going to fall a little bit, bounce a little bit, fall a little bit, bounce a little bit, and then really fall and then have a big bounce, right? That's kind of what I'm expecting this year, okay? I think ultimately you'll probably end the year positive on markets, but it's going to be very volatile, especially as the current administration does not care about stock prices. They actually want stocks to fall and they want bonds to rise, which by definition, if they want bonds to rise, they want stocks to fall because that is the correlation between stocks and bonds. So I just think it's time to be a little bit careful out there, raise some cash, pay off margin if you have not done so already. Get your margin ready for when we do get a full-blown, correction or crash, whatever it turns out to be. You can go shopping at lower levels, and actually put that margin to work. You really only want to use margin in select specific opportunities. If a stock is just, beat down for no reason, that can make sense to use margin. Obviously, contact financial advisor. I'm not a financial advisor. You take any and all risk and liability when you make financial decisions. Okay. You get that if you watch financial YouTube. I don't even know why I have to say this anymore because it's pretty self-explanatory. But you want to have that margin available, or at least I do, when shit does really hit the fan. Because emotions are going to be even higher than they are now. People are going to be panicking eventually. And I think it really has to do with the economy. Even, Tom Lee with Fundstrat is not very excited about the employment outlook for this year. So let me know what you guys think about this down below in the comment section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.